Three main kinds of current transfer are current taxes on income and wealth, social contributions and benefit, other current transfer. First, current taxes on income, wealth, etc. It consists mainly of taxes on the incomes of the household or, or profits of corporations and of taxes on wealth that are payable to the government. To put it in short, it consists of income tax and wealth tax payable by household and corporations to the government. Social contributions and benefits. Social contributions are payments to social insurance scheme and other social security payments like provident fund, payment to new pension schemes, etc. These payments are made either by employers or employees or by both. This is important. Households themselves make these kinds of payments in their capacity as employed, self-employed or unemployed person. Social benefits are current transfers received by household. Okay, it is the intended to provide for the need that arise from certain events or circumstances, for example sickness, unemployment, retirement, housing, education or family circumstances. Social benefit may be provided under social insurance schemes or by social assistance. Examples for social insurance scheme are Pradhan Mantri Suraksha Bima Yojana, Pradhan Mantri Jeevan Jyoti Bima Yojana. Example for social assistance are Indira Gandhi National Old Age Pension Scheme. Next part is other current transfers. Okay, so other current transfers other than taxes on income, wealth, and social contributions and social benefits are called other current transfer. Other current transfers include the following: net premiums and claims under non-life insurance policies, current transfers between different kinds of government units, usually at different levels of government. Okay, uh, also between the general government and the foreign government, such as transfer under aid programs intended to sustain the consumption levels of population affected by war or natural disasters, such as drought, floods, earthquakes. Current transfer to and from NPISHS and current transfer between resident and non-resident households, for example, foreign remittances between residents and the non-resident household. These current transfer payments and receipts are between resident institutional units or between resident and non-resident units. Transfer from one resident unit to other resident unit does not make any impact on disposable income of an economy as it is within the economy. If it reduces disposable income of one resident unit who pays, it increases the disposable income of receiving resident unit. But the current transfers between resident and non-resident units affect the disposable income of the economy. The net current transfer paid to and received from non-resident unit is called net current transfer from ROW. Okay, if net current transfer from rest of the world is positive, GNDI, gross national disposable income, is higher than GNI. Okay, this is important. Next point: GNDI is more than GNI if net current transfer from ROW is positive. GNDI is less than GNI if net current transfer from ROW is negative. The press note on new series estimates of national income, consumption, expenditure, saving, and capital formation released by the Ministry of Statistics and Program Implementation, Government of India, dated January 30, 2015, has formula for various measures of national income. As per this note, the formula for GNDI is as follows: GNDI is equal to GNI plus net other current transfer from rest of the world. The same press note has remarks on the formula. It reads other current transfers refer to current transfers other than primary income. From this remark, it can be inferred that other net current transfers include all three components of current transfer. For example, current taxes on income, wealth, and social contributions and benefits, and other current transfer. Net national disposable income. By adding net other current transfer from rest of the world to NNI and to NNDI can be arrived at. NNDI is equal to, it means net national disposable income, it is equal to NNI, net national income, plus net other current transfers from rest of the world. By deducting the consumption of fixed capital from the gross national disposable income, also net national disposable income is obtained. Okay, gross disposable income of government. Gross disposable income of government, as said earlier, the disposable income is the total income available for spending and income available for saving. Gross disposable income of government is equal to GFCE, government final consumption expenditure, plus gross saving of general government. Okay, this is important. Next, gross disposable income of household. The gross disposable income of household can be arrived at from gross national disposable income by deducting gross disposable income of government minus gross disposable saving of government of all corporations. Okay, this is of government, this is of corporations, and this is of household. Okay, the above calculation of national income is based on the output method. The national income can be calculated based on the expenditure method too. Okay, next is the expenditure method. The calculation of GDP above was gross value added method, or output method, or GNI was by income method. Okay, the GDP can be calculated by expenditure method. As seen in the flow of income, output is equal to expenditure. Hence, GDP can be calculated by expenditure method as well. The income earned is used for consumption and saving. The total of this should be equal to income. Income is equal to what? Consumption expenditure plus saving. This is important. The consumption expenditure is done by both private and government. Savings are ultimately used for investment in fixed asset and financial assets. Investment in fixed asset and financial assets put together are called capital formation. So the above formula can be rewritten as follow. Income is equal to consumption expenditure plus capital formation. Okay, as per the system of national account 2008, in India, the formula for GDP under expenditure method is as follow. GDP is equal to private final consumption expenditure, it is private, then it's government final consumption expenditure is government, plus GCF, then plus export of goods and services minus import of goods and services plus discrepancies. Okay, this is a gross capital formation. In the above formula, PFCE, GFCE, export of goods and services minus import of goods and services are expenditure items. GCF, that is, this is the saving item. In SNA, final consumption expenditure is incurred only by general government. NPISHS and households. Corporations do not have final consumption expenditures. They may purchase the same kinds of goods and services as households use for final consumption, for example, electricity or food, but such goods or services are either used for intermediate consumption or provided to employee as a remuneration in kind. Private final consumption expenditure. Final consumption expenditure is the amount of expenditure on consumption of goods and services. Consumption of goods and services. Consumption of goods and services. The final consumption expenditure borne by private is called private final consumption expenditure. Here, by the word private, we means households. Okay, all consumption expenditure by household is incurred by them for their own benefits. Final consumption expenditure are incurred both within the economic territory and the rest of the world. The private final consumption expenditure is expressed in formula form as follows. Private final consumption expenditure is equal to private final consumption expenditure in domestic market, final consumption expenditure of resident households in the rest of the world, minus final consumption expenditure of non-resident households in the economic territory. Okay. Next part is government final consumption expenditure. Final consumption expenditure is the amount of expenditure on consumption of goods and services. The final consumption expenditure borne by the government and NPISH is called general government final consumption expenditure. Consumption expenditure by the central government is either for the benefit of the community at large or for the benefit of individual households. The example for the consumption expenditure by the government for the benefit of community at large are control of law and order, disease control measures, etc. The examples of consumption expenditure by the government for the benefit of individual households subsidize the public distribution, disaster relief payments, etc. The expenditure that government unit or NPISHS makes on individual goods and services that they provide household as social transfer in kinds are recorded as final consumption expenditure incurred by the government units or NPISH. Gross capital formation. Gross capital formation refers to the addition of new capital assets. Addition of new capital assets. From addition of new assets, the disposed assets are deducted. Disposed assets are deducted. Okay, they are minus. And the net addition of capital assets is called gross capital formation. The capital assets are fixed assets like building, machinery plus inventories and valuables. The estimation of gross capital formation is dealt below. Next part is export less import. The difference between export of goods and services and import of goods and services is called net import. That is important concept. Such concepts are asked in the UPSC prelims in conceptual MCQ based questions. Excess import over import export is the amount of consumption expenditure that goes to GDP of the other country, hence it is deducted from GDP. Discrepancies. Next part is discrepancies. GDP calculated by gross value added method and expenditure method. Gross value added method and expenditure method differ as the difference in value recorded for the product between when it is produced and the moment it is consumed are considerable. There may be loss or gain in the value or quantity during storage or transport of products. It leads to difference in the estimates by these two methods. This difference is treated as discrepancies. Gross capital formation minus estimation. Gross capital formation is estimated by two approaches. These are funds flow approach, commodity flow approach. In commodity flow approach, the investment are made in different types of assets forming part of the gross capital formation are measured either by industry wise or institutional sector wise. The investment in these assets comes from financial saving. Okay, so adding the gross saving of domestic institutional sector and the fund flow from rest of the world will be equal to the investment made in different types of assets. So gross capital formation is calculated by adding gross saving of domestic institutional sectors and fund flow from rest of the world. This latter is method is called funds flow approach. Funds flow approach. As said earlier, the investment has to come from financial savings. Hence, in the fund flow method, the gross capital formation is derived as gross saving plus net capital inflow from abroad. Gross capital formation is equal to gross savings plus net capital inflow from the rest of the world. Gross saving is equal to saving of non-financial corporation, saving of financial corporation, and saving of central government, and saving of household. Net capital inflow from abroad is capital inflow from rest of the world to the economic territory less outflow from economic territory to the rest of the world. Institutional sector wise gross capital formation. Investment made by the following institutional sector: public non-financial corporation, private non-financial corporations, public financial and private financial, then government, then household sector. In the following assets are added together, arrive at institutional sector wise gross capital formation: dwellings, other buildings and structures, machinery and equipments, cultivated biological resources, intellectual property, products. In the way gross capital formation calculated by institutional sector wise, it can be calculated industry, agriculture, industry, mining, etc. wise. It is called industry of use method. Industry of use method. However, gross capital formation by industry of use and by institutional sectors does not include valuables, and therefore these estimates are lower than the estimates available from commodity flow. This is important. The estimates of gross capital formation through the flow of funds approach are treated as the firmer estimates. Okay, funds approach means the firmer as the data availability for fund flow. Okay, approach is easier and less error prone. This is not the case with the commodity flow approach. So it leads to difference in the gross capital formation calculated by these two methods. The difference between two approaches is taken as errors and omissions. Net capital inflow from rest of the world is equal to capital inflow from rest of the world to economic territory, capital outflow from the economic territory to rest of the world. Commodity flow approach. The gross capital formation is estimated by the type of asset. There are three types of assets: gross fixed capital, inventories or change in stock, valuables. Gross fixed capital. Gross fixed capital refers to the fixed assets like building, plant, and machinery used in the production. Fixed assets are produced assets that are repeatedly or continuously in production process for more than 1 year. Okay, this is important. They are durable and put into productive use to produce goods and services. Fixed assets include not only structure, machinery, and equipment, but also cultivated assets such as trees or animals that are used repeatedly or continuously to produce other products such as fruit, dairy products, etc. This is important. They also include intellectual property products such as software or artistic originals used in the production. Okay, change in stock. Change in stock. Input materials to be used in production, semi-furnished finished goods and unsold finished goods are called inventory. The input materials are called goods of intermediate consumption. They are used to produce either consumer goods or fixed assets or valuables. Semi-finished goods. Semi-finished goods are goods in the process of production of consumer goods or fixed assets and valuables. Take an example of shoe manufacturing industry. The raw leather is input material. The processed leather are semi-finished goods and the shoes are finished goods. Assume that the same shoe factory is expanding its capacity and the construction is going on. The building in process is semi-finished fixed asset. The input material and semi-finished material, okay, neither can be consumed nor used as a fixed asset or stored as valuables or valuable. Likewise, the unsold finished goods are also neither can be consumed nor used as a fixed asset and stored as valuables. To put it simply, the product till they reach market as final goods and services are called inventories. But the expenditure on such product is incurred by the producers of the goods and services. Hence, they are accounted for expenditure method. Okay. The inventories, once they become final product on the sale of consumer as a consumable products or valuables or to the producers as fixed asset, are accounted as either PFCE or as GCS, gross capital formation, in the subsequent years. Likewise, in the subsequent years, new inventories are added. The inventories are measured on net basis. Inventories are measured on net basis. The inventories on the first day of the accounting period are deducted from the inventories on the last day of the accounting period. It is called change in the stock. Change in the stock. The inventory existing on the first day is deducted from the inventory on the last day of the accounting period, because inventory on the first day was already accounted in the previous year. It ensures only the current period inventory alone is accounted for the current period. In India, accounting period is April to March. The following example makes it clear. Inventories on 1 April are 100 crore. Inventories on 31st March 2016 is 150 crores. Change in inventory is 50 crores. Inventories capture the expenditure to the extent the products are completed. They do not capture final expenditure. Valuables are expensive and durable goods. Valuable include works of arts, precious metals, stones, and articles of jewelry. They are one form of investment. During needy hours, they can be sold and used for the needed purpose if necessary. Earlier, the valuables were treated as consumption, but it is the new series treated as asset. Both fixed assets and valuables are durable goods, but the distinction lies in the fact that fixed assets are those durable goods used in production of goods in services. Valuables are just investment as store of value to be used for the future needs. National income and constant price. To calculate and compare the national income of previous year, the national income is calculated with reference to particular year. It is called base year. The price in this year is called price of the base year or constant price. The national income at constant price means total quantity of all final goods and services produced in a particular year multiplied by the price of the base year constant price. The national income calculated by this method is called real income. National income at constant price is equal to total quantity of final goods and services produced in a particular year into price of the base year constant price. National income at current price means the total quantity of final goods and services produced in a particular year multiplied by the price of the particular year current price. National income calculated by this method is called nominal income. National income at current price equal to total quantity of final goods and services produced in a particular year into the price of goods and services in that particular year. For example, take 2004-5 as the base year. National income at 2009 constant price is equal to total quantity of final goods and services produced in 2008-9 and into price of 2004-5. The reason behind calculating the national income at constant price is to check whether national income has grown or not. Take the following example. The base year 2004-5 base year price 100. Total quantity for 2007 and 8 price 110. National income at current price is 13,200. National income at constant price is 12,000. Similarly, for national income 2008-9 total quantity 110, price 130. National income at current price 14,300. National income at constant price 11,000. National income for 2008 and 9 at current price is 14,300, which is higher than the national income for 2007-8 at current price of 13,200, but national income for 2008 and 9 at constant price is 11,000, which is less than national income for 2007-8 at constant price. This is because actual quantity produced in 2008 to 9 is less than that of 2007 and 8. It means no real growth has taken place in 2008 to 9. GDP deflator. GDP deflator, implicit price deflator for GDP, is measure of the levels of prices of all domestically produced final goods and services in an economy in a particular period of time. This is calculated to find the overall rise in the level of price. GDP deflator is what? Nominal GDP divided by real GDP into 100. Okay, real GDP is equal to what? Then nominal GDP divided by GDP deflator. Okay, national income growth. National income growth at current price is equal to national income of this year at current price minus national income of previous year at current price into 1000. In our national in our example, national income growth at current price for 2008, ठीक है, that is calculation. National income at current price shows positive growth, whereas at the same time national income at constant price shows negative growth. It means what? There is growth in national income, but that's not the real growth. Incremental capital to output ratio. Incremental capital output ratio. Capital output ratio is the ratio between capital and output. Okay, capital divided by output. It shows the amount of capital required to produce a product. Incremental capital output ratio means the additional amount of capital required to produce one additional output. It helps to calculate the amount of capital investment required to achieve target growth rate. Growth rate is equal to capital investment divided by incremental capital output ratio. Capital investment is equal to growth rate to incremental capital output ratio. For example, if the ICOR is 4 and targeted growth rate is 8, the required investment is 84, 32%. I will repeat once again. Capital to output ratio is capital divided by output. Incremental capital output ratio means incremental capital divided by incremental output. So growth rate is equal to what? Incremental capital or capital investment divided by ICOR. And capital investment is what? Growth rate into ICOR. So for example, ICOR is 4% and targeted growth is 8%, then required investment is 32% increase. Okay, this formula is used by Harald Domer in their growth model. Estimates of national income in India. The calculation of national income dates back to pre-independence period. This is updated, modified and fine-tuned to changing times. Before independence, 1868, Dadabhai Naoroji wrote a book named Poverty and Un-British Rule in India. In that book, he estimated per capita income of Indian as 20. Therefore, following persons had also calculated per capita income. Findlay Shiraz in 1911 49 rupees. Wadi and Joshi in 1314 44.30. For the period of 1925 to 29, V.K.R.V. Rao calculated per capita income of Indians as 76 rupees. He was the first person to estimate national income scientifically with proper method. National Income Committee after independence was formed in 1949 under the chairmanship of Professor P.C. Mahalanobis. It submitted its final report in 1951, final report in 1954. It reported the per capita income was 246.9 246.9 in for the period 2050 to 54. Later, the Central Statistical Organization (CSO) was formed. The first official estimate by CSO was in 1956 with the base year 1948 to 49. Base year has been shifted 7 times so far: 60, 61, 70, 71, 80, 81, 93, 94, 99, 2000, 2004, 2005 year 2011, 12 is the new base year. New series of national income was started in 2015 January with new base year 2011 to 12. It is based on the international guidelines The international guidelines are taken from SNA 2008 of United Nations. In the old series, GDP factor cost was called GDP. GDP at factor cost was called GDP. But in the new series, GDP at market price is called GDP. This is important difference. Okay, new series and old series. Earlier, sector-wise manufacturing data on value addition was sourced from RBI Industrial Outlook survey conducted on quarterly basis and annual survey of industries. The Industrial Outlook survey is based on sampling method. The ASI annual survey of industries being an annual exercise was extrapolated using index of industrial production IIP to calculate the value addition in intervening period to publish quarterly estimation. But now for incorporated sector along with IIP data to MCA 21 data is also being used with the Ministry of Corporate Affairs, making it obligatory on the part of companies registered under the Companies Act for online reporting. The MCA 21 database has been used for manufacturing sector additional data. The MCA database cover as on the date covers 5 lakh companies. It captures the data on value addition completely rather than capturing sample data. This is important. MCA 21 is e-governance initiative of Ministry of Corporate Affairs. One more advantage of MCA data is that it captures the entire value addition done by enterprise including advertisement, brand building. This is called enterprise based method. In old method the value addition data was obtained industry wise. It captured only value addition in manufacturing. It is called establishment method. An enterprise is a unit of production, producer and goods and services. It may be a company or partnership firm or proprietary concern. It may engage in production of different kinds of goods and services. An establishment is a unit located in a single location and involved in single productive activity or in which principal productive activity accounts for most of the value added. An enterprise may have different establishments within it. For example, a company may produce talcum powder and advertise it and market it. It has three establishments. One is manufacturing, second one is advertising agency, and third one is marketing agency. In enterprise method, all the data is captured in a single place. With establishment method, establishment wise data needs to be collected from different enterprise. Effective labor input method is adopted for unincorporated manufacturing and service enterprise for compiling the estimates of unorganized and agriculture sector through survey value addition per labor is calculated and amount of labor used in unincorporated enterprise is multiplied by per labor value addition to calculate total value addition of it. Earlier labor input method was used but now effective labor input method is being used. This method assigns due weight to different types of worker. Okay, due weight to different types of workers based on productivity and skills. Unlike the earlier method, which assumed equal value addition of each worker irrespective of their skills and productivity. For this, the details of new NSS survey, Unincorporated Enterprise Survey 2010-11 and Employment and Unemployment Survey 2011-12 are used. Gross value added per worker was obtained from enterprise survey of NSS and labor input was obtained from employment and unemployment survey. The timelines of data availability in old series and the new are given in the following table. Series 2004-5 series. Year 1 Advanced and Provisional IIP. Year 2 First Advised Estimates IIP. Year 3 Second Advised Estimate ASI. 2011-12 series. Year 1 Advanced and Provisional IIP plus Advanced Filing of Corporate Accounts. Year 2 First Revised Estimates IIP plus MCA 21. Year 3 MCA 21 plus non-corporate ASI. It may be noted that IIP is pure volume index. Value added data is available from accounts, and the ASI in 2011-12 series captures value addition information based on corporate filing right from the first year. Right from the value addition data based on corporate filing right from the first year and comprehensively from the second year as against 2004-5 series, where this information was getting captured only in the third year. The trade sector, the gross value added was earlier calculated. In the trade sector, gross value added was earlier calculated using gross trading volume index. This has been replaced by index derived from sales tax collection and GST collection. Okay, and gross trading income is an index of trading income of all commodity producing sectors. The trading income is derived from the marketable surplus of these commodities by applying trade margins. The gross trading income index tracked the growth on volumes of tradable goods in the economy derived from current estimates of production in agriculture and manufacturing. The underlying assumption was that value added is strongly correlated with the physical volume of goods available for trade. This is a reasonable assumption in short interval of time. However, when projections are extended over a long period of time, the error builds up. This is because, in addition to physical volume, value added also depends on the level of intermediate between the producer and the consumer. Changes in the underlying quantity of goods, changes in the marketing practices, for instance, bundling higher quality value added services with goods like warranties, underlying quantity of goods, changes in the marketing practices, for instance, bundling higher quality value added services with goods like warranties, etc., and so on. In the current news series, in addition to updated survey, this has also been partly corrected by changing the underlying indicator from volume indicator to one based on the value named as sales tax and GST collection. Since sales tax and GST is value based, the growth in indicator this indicator captures the underlying growth better in value added. In the new series, data collected from local bodies is also used and the coverage is 60% related term. Index of industrial production. It measures the growth of industrial production in India. This index classifies industries into mining, manufacturing, and electricity sectors and measures growth in production in each industry. In addition, use based classification of basic goods, intermediate goods, and capital goods is also available. This helps in predicting the GDP growth as industry is one of the major contributors of growth. IIP is released by CSO on monthly basis. The base year is 2011 and 12. Nikkei Manufacturing India Manufacturing Purchasing Managers Index. Nikkei India Manufacturing Purchasing Manager Index is published every month by Nikkei Media House. It is compiled by IHS Markit. Purchasing Managers Index predicts the level of industrial production in advance. Okay, predicts the level of industrial production in advance. It predicts the industrial growth, industrial production by tracking the following parameters: new order flows, output, employment, stocks of items purchased, and suppliers delivery time. This is done by surveying purchasing executives over 400 manufacturing companies in India. Okay, the index above 50 reflects expansion and below 50 reflects contraction in the industrial production. IHS Markets India Service PMI. It is compiled by IHS Market Service PMI predicts the level of service sector output in advance. This is done by surveying purchasing executives over 400 service company in India. This index is above 50 reflects expansion and below 50 reflects contraction in the service sector output.